I'm Jen Nevin, and today we'll be discussing the latest edition of the Canso Market Observer. Today I'm joined with Jeff Carter and Jason Bell. Thank you guys for joining me. So let's jump in. Jeff, how have Canadian bonds done relative to US, and what do we expect going forwards?
Sure. I guess I'd make a couple observations. First of all, if you look at the front end, the very front end of both the US Treasury and the Canadian curve, US yields have dropped quite a bit more than Canadian yields this year. We've all seen the political pressure on the Fed to lower rates, which they have done once this year, and there's several more cuts that are priced in as expectations into the market. 1 year US Treasury yields have lowered by about 90 basis points this year, while Canadian rates have just moved 30 basis points. In fact, just yesterday, the Canadian Central Bank actually came out and said that the current level of monetary stimulus is actually appropriate for the market. So really, it's a tale of two central bank boards. Further out the curve, if you look at the 10 and 30-year sectors of the curve, really Canada has rallied, not to quite the same extent as the US, but it has rallied substantially. And I think really the message there from the market is that right now, Canadian and US yields relative to other G7 countries actually look quite attractive. In the long run, I'd say we expect when the US reverses course and yields normalize to higher levels in the US, we expect the Canadian to follow suit and sell off along US yields.
And Jeff, what are investors doing to boost yields in their portfolios?
Sure, Jen. I think one of the things we've seen in the credit market this year is a classic reach for yield. That is, investors are willing to buy lower credit quality bonds and loans for ever lower yields. If you look at the fourth quarter of the last year in the US high yield market, it was soft. This year we've seen nothing but buying, pushing prices higher and higher. In fact, the total return year to date in the US high yield market is approximately 11%. Meanwhile, new issue high yield deals coming to market today are coming with coupons of 5% or even lower. We think that tells us that there's quite a bit of frothiness in the market and that it warrants caution. And when we think about our investors' capital, we don't want to have weights that are too high in the high yield market. We think there'll be better opportunities further down the road.
And Jason, what do lower yields mean for Canso's portfolios?
Well, look, investing is a relative game. You're trying to do the best you can with the cards that you're dealt. And so today's environment is a low interest rate environment. It makes things a little more difficult for us. We have to search a little bit further, a little bit harder for value, be a little more skeptical. But ultimately, we're trying to seek value where it's available. The other thing we like to tell investors, and this is a common misnomer, is that yield isn't your entire return. You can have a yield of 3% of portfolio. That doesn't mean you're going to return 3% this year. If you go back to 2007, Canso's corporate value portfolio was yielding 5%. In the year 2009, that same portfolio earned 26%. So those two things don't have to be correlated because there's always opportunities when yields change to take advantage of falling bond prices, and that's what we try to do at Canso.
Well, thank you both for joining me. For more information, go to the Canso Fund's website and read the latest edition of the Canso Market Observer.